Think about the last sale you jumped on, the WhatsApp tip you almost bought, or that time you opened your portfolio 10 times in one day. We've all been there. Today, let's uncover the 10 most common investing mistakes, why they happen, and the simple fixes that can save you lakhs to crores over a lifetime. First, chasing what just did well. We buy after a big rally and sell after a fall, because the recent past feels like the future. But leadership rotates across sectors, styles, and assets. Always set your asset mix first, invest steadily, and rebalance. Don't chase what already did well in recent past. Second, trying to time the market. Even pros struggle to get in at bottoms and out at tops. The market's best and worst days cluster together. Miss a few best days and lifetime returns plunge. Remember, time in the market is always more important than timing the market. Use SIP and automatic contributions as a remedy. Third, overtrading and overconfidence. Large real-world studies of brokerage accounts show that frequent trading usually reduces net returns after costs and taxes. More action is not equal to more gain. Quite the contrary. We suggest you to always write rules, buy monthly, hold long, and rebalance annually. Take fewer but better decisions. Fourth, ignoring costs. Math time. Invest rupees 10 lakhs for 30 years. At 12%, it becomes almost 3 crore. At 11%, just 1% lower return, it falls close to 2.3 crores. Cost of that 1% over 30 years compounds to over 70 lakhs. Yes, focus on future return potential, but do not ignore costs. Avoid high-priced new fund offers if they offer the same portfolio packaged in a new name. Prefer proven funds with lower expense ratios. Fifth, no diversification. Too much in one bet. Returns in stock markets are skewed. A small fraction of companies create most long-run wealth. Concentration risks missing the winners or riding a loser too long. Instead of overconcentration, prefer to own the entire haystack through broad funds or diversified baskets, so the needles are not missed. Sixth, checking portfolios too often. Research proves that losses hurt about twice as much as gains feel good. If you check daily, you'll see many small losses and may panic out of a good plan. Instead of checking frequently and randomly, decide check-in dates, be it monthly or quarterly, and learn to separate the noise from news. Seventh, no emergency fund may lead to forced selling at the worst time. Without a 3 to 6 month buffer, you might sell growth assets during a downturn, locking in losses. That's a sequence of returns risk in real life. So build a liquid buffer which is enough to take care of 5 to 6 months of your expenses before ramping up risk assets. Eighth, not rebalancing. After rallies, equities can overweight your portfolio. After falls, they underweight. Unmanaged drift changes your risk profile without your consent. As a fix, rebalance to target weights on a schedule. For example, annual or half-yearly, when a bucket moves plus or minus 5%. Ninth, forgetting inflation, money illusion. If inflation runs at 6%, then rupees 1 crore in 20 years has the purchasing power of rupees 31 lakhs of today. Nominal targets can overstate your future security. So, plan in real terms. Use assets with growth potential for long goals. Keep safe money for near-term needs. 10th, starting too late. An SIP of rupees 10,000 per month at 12% monthly compounding done for 25 years results in 1.9 crores. But if the same SIP ran for 20 years, it results in a corpus of lesser than 1 crore and almost reduces the corpus by half the amount. A 5-year delay cuts the corpus by almost 50%. Time is a multiplier you can't buy back. So start small, but start now. Increase contributions as your income grows. Here is your quick anti-mistake playbook. Write a simple plan, including goals, time horizons, target asset mix, and your risk tolerance. Automate contributions and dividend reinvestment where suitable. Diversify broadly, rebalance on schedule. Minimize costs and taxes. Avoid unnecessary churn. Zoom out your view. Don't let headlines drive your trades. The market rewards behavior, not bravado. If you avoid these 10 traps, you don't need to predict the future, you need to prepare for it. Start early, stay diversified, keep costs low, and review calmly. That's how ordinary investors get extraordinary outcomes. If this helped, share it with someone who keeps waiting for the right time. The right time is usually now, and the real secret is sticking with the plan.